What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey. This week, Stephen and I are joined by Jake Oubina, who's a senior economist at Piper Sandler. Jake, welcome to the podcast.
Hey guys, good to be here.
All right, so Jake, this week, we had a busy week, a lot of macro data, and particularly we got CPI data, which you are like the CPI guy here at Piper Sandler, probably get deeper into the weeds than most on Wall Street. So want to hear what your views are on inflation, what you saw in this week's inflation report. We beat on the headline index, but we came in a little cooler on core. That's been a message that you've been telling clients. So congrats on a good call there. Is this going to continue, or are we going to need to continue worrying about higher interest rates, higher inflation, and the potential for Fed rate hikes later this year?
Yeah, no, I think this is a continuation. We've got a lot of momentum and a lot of the underlying indicators now where it's almost becoming a mechanical process at this point. Our biggest worry and the market's biggest worry, and obviously we had a take on this where we weren't worried very much about energy price shock, the commodity price shock spilling over into the core, but you have to assign some probability of that, obviously. But I would say the market had assigned a pretty significant probability to that when you look at inflation pricing, at least over the course of the next year or so. And we just haven't had that, right? So our view on that has been, look, commodity shocks tend to act like taxes. They don't tend to spill over into the core unless you've got some monetary fiscal offset or unless the household sector is leveraging up. So I think setting the table on that first, that we went through this commodity shock. We've seen zero really spill over into core inflation. And this is because monetary policy is still at neutral at best here. Fiscal, you're not getting any ammunition from there. You're not getting energy rebate checks being sent out to households or things like that, which would actually give you a more permanent price level shift and perhaps spread out even more throughout other CPI categories. And household leverage is still pretty close to zero in terms of the bank lending side in kind of real terms here. And so you don't have that mechanism either. Without a monetary mechanism, you just don't get any spillover from commodity shocks onto the core. And we did this, we did historical studies on this and proved this out. And I think it's been the right call, at least so far. So if that's true. And maybe Iran is finally, this is what, the 39th or 40th time that this thing's been over now. I don't know, but maybe it is over now. And we have this reversal now coming in the commodity side, which commodity prices in general, they're off about 12% from the highs. So we're on the other side of it already. And now what you're going to start seeing is more downward pressure on the headlines. I'll give you a good stat here just to keep in mind for June. But if gasoline prices average $4.25 a gallon in June, and they're already below that, we just dropped below $4.15 in the last couple of days nationwide, and we're still not even halfway through the month. But if we just average 4.25, headline inflation for June is going to print zero month over month. And if we average something closer to 410, which is the trajectory that we seem to be on here, or even lower, we're going to have a negative print for headline CPI month over month. And we're going to have a negative print for headline CPI most likely in July as well. The energy curve itself, and rightly or wrongly, is still telling us that retail gasoline is heading back down to $3.50 by the end of the second half of this year. And we're going to have the complete opposite conversation vis-a-vis headline inflation that we're having today. And I think, look, the inflation market is starting to sniff that out. We had 1 year inflation premium move all the way down to 285 yesterday. It was 3 just a couple of days ago. If Iran is resolved and you get further downward pressure on these commodity prices, which I think you would, then we're probably going to realize something closer to 250 to 260 over the next year on headline inflation. And that's way better than what we were thinking just several weeks ago when we were pricing 350. On the core, the mechanical stuff, right? So shelter will continue to disinflate, consistent with what's been happening with rental markets. We're kind of blue in the face talking about this over the last several quarters and even years now, but rents continue to disinflate and outright deflate. From the apartment side, you're down 1.5% year over year. You're just going to have, that thing's just going to act like an anchor on core CPI and to some extent core PC as well, just on a go forward 12 to 18 month basis here. Goods printed negative in May. Why is that happening? We printed, again, the weakest read since Liberation Day. Liberation Day, you jacked up tariffs. You had some goods price inflation feeding through. Now tariffs peaked in October. They're down over 100 billion from the highs annualized. And that's now feeding through into lower goods inflation. Goods are going back to their classic modality of deflation. That's what goods do. Hyper competitive markets, et cetera. And so unless we're going to have a significant ramping up in tariffs. And that's certainly a possibility once you get into July. 301 tariffs are on the table again. There's a comment period in early July. If you get a re-escalation and a re-upping there, then you could see some emergence of more pressure on the good side. But tariffs are still going to be lower than they were in the second half of last year, even in a worst case scenario, 301 basis. So the pressure's still on the other side. And then you've got things in the services side, which are going to start coming off the boil. Airfares, you look at average transaction prices there, they're flat to down in May. Now, a lot of the bookings still have to come through because the companies will realize revenue when people actually take the trip. And so a lot of bookings that were done with higher prices have to filter through the system here. So you probably get a peaking out there sometime in the summer, but you're going to be on the other side of that. Jet fuel is down significantly from the highs. Companies are going through pricing power pressures as well. So airfares, by my estimation, are going to be a notable drag on the core services piece in the second half of the year. You've got things like motor vehicle insurance, which are now in full-blown deflation as they catch up to lower pressures from pricing there in the auto space. That acts with a lag. So there's a lot of reasons, I can go on and on here, but there's a lot of reasons to think that just from a mechanical process standpoint, you've got a lot of things cooling off here on the core side, and in particular, some of the services components. And so unless we're going to get some monetary phenomenon, some fiscal impulse that is significant, or the household sector is all of a sudden going to lever up massively, and I'm talking 10 to 20% rate of change, which is just not going to happen here. Inflation will just continue to track lower.
Wow, Jake, that's the most dovish take I've heard on inflation in years. And I could see how you're getting to those conclusions. I wonder if in the back of Trump's head, ending this war is something that's important to do so before the Kevin Warsh first speaks as the new Fed chairman next week. That would certainly, I think, maybe provide a little relief on some of the fears of higher oil and gasoline prices that you mentioned. So it sounds like you are not expecting the Fed to hike this year, and you also believe that core inflation is coming down. Where do you guys see core ending the year?
So I've got core CPI at about 2.3 year over year. I think the annualized run rate, so the sequential quarterlies, will be a little bit weaker, and I think potentially even below 2. Depending on how quickly the rent piece catches up. It's been like molasses, but slowly but surely you're going to get there. You look at something like core X shelter, right? Which you're taking out the commodity shock here, which again, we see unwinding from here. You take out food, which has been directly impacted by what's been happening with the commodity shock, vis-a-vis fertilizer prices, et cetera. And you take out shelter, which in the real world, is deflating. And that run rate in May was about 1.8% on a 3-month change basis, right? You just do a historical chart on that. That's fully contained. There's nothing wrong with inflation when you look deeply beneath the hood there. So if we can get, again, the shelter piece working and this Iran thing is indeed getting resolved and the commodity shock is behind us, and you do get very substantial price level shifts to the downside with commodity shocks historically, and we're going to get that again, then I could see a world where, you're potentially below 2 on a sequential basis. And I think when you're this time next year, by the way, if the curve is right, we're going to be comping to very elevated, for example, gasoline prices at 450, 460, right at the peaks here in the first half of this year, with gasoline that's probably going to be in the low 3s again, and 3.25, 350 max. And that's going to put significant downward pressure on the year-on-year rate of headline inflation. We could get a one handle on year-on-year headline inflation in the first half of next year. The setup for Warsh, I totally agree with you, is great here from the inflation side. I mentioned 1-year inflation break-evens. They actually traded all the way down to about 275 now, 285 after the news hit that a deal was imminent. But now we're all the way back down to 275. That's a massive squeeze in what the interest rate curve's been pricing in terms of short-term inflation. And even more importantly, with respect to how Warsh can pitch this, you look at something beyond the 1 year, which is still being influenced by the commodity shock here. Now, 4-year, 1 year is all the way down sub 250 now. So there is no unmooring or unanchoring of inflation expectations in the long run. And you can come up with a pretty good thesis here on why the core on an ongoing basis should continue to track lower. So I think the setup is quite good for Warsh's pitch.
Well, that could certainly be a big upside surprise for the market, because I think there's still a lot of uncertainty in terms of how he's going to talk about the dot plot, how he's going to assess the current backdrop. And if he comes into it with this short tailwind here of disinflationary forces, I think that would be potentially set us up for a really good day in the market and potentially a good period in the market. If we get anywhere close to your forecast by year end of 2.3 on core inflation, I see pretty easily getting to S&P 8,000 because that, in my book, would mean the Fed hikes are priced out almost in its entirety. The 10-year yield, all else equal, is probably lower, perhaps 20, 30 basis points from where we are here. And to me, that means multiple expansion and a broader market. And some of the areas of the market that we have certainly called out in the last 3 weeks, as we agree with you and see several other reasons that rates could come down, are the consumer stocks, the housing stocks, the XRT, the XHB, even biotech, other rate sensitive names. We've seen the market broaden out every time rates have come down. The biggest concern, or one of the biggest macro concerns over the last few weeks, has been the record low, once again, in UMich consumer confidence. This sounds to me like that should see some retrieval in the coming weeks and months, if indeed that forecast plays out.
Yeah. And look, I think the thing about the confidence numbers too, right? And we were never worried that the gasoline shock was going to be a derailing moment for consumer spending. Again, we've become incredibly insulated to gasoline shocks vis-a-vis the consumer over the last couple of decades. The wallet share of spend on these things on the energy complex has just dwindled. The energy intensity, if you want to look at just real spending of energy goods and services as a percent of total spending, again, just melting down like a waterfall over the last 20 years in particular. But we were worried because we're worried beneath the surface because gasoline tax is very regressive, right? So the lowest couple of income quintiles do get hit very substantially, and that's weighed on certain pockets of the consumer complex for sure. So as an example, even if gasoline futures are right that we're going to have this waterfall in gasoline prices in the back half of the year, and we're going to 350, and I think that'll adjust even lower if the Iran thing is finally for real. It's still about a 1 percentage point headwind on the lowest quintiles income, right? Just because of the change in gasoline prices cumulatively from where we were, what we thought about the gasoline complex pre-Iran. And it's about a 6/10 impact on the second lowest. The highest, it's a rounding error, right? If we had $5 gas, which was something people were kicking around not that long ago in terms of looking ahead to the third quarter, that's closer to a 3% headwind on income of the lowest tier and almost 2% on the second lowest. So the gasoline phenomenon, the gasoline squeeze here has manifested on a population adjusted basis, weaker consumer profiles, right? Because they're not a huge part of spending, but they're a huge part of the population, obviously. And so I think that's also showing up in weaker confidence because confidence is ultimately an equal weighted index, right? Whereas you look at aggregate consumer spending, and that's more of a market cap weighted index or number. And yeah, I totally agree. I think if the squeeze is finally over here on the gasoline front, if we are going to see this slide now, you will see confidence improve. And you also, at the same time, will see a lot of this pressure that's been put on kind of the consumer sectors that are most exposed to these lower income quintiles come off the boil as well. And I think you'll see them do better. And then on housing, I totally agree. This has been our call here that rates and vis-a-vis the Iran conflict have been the biggest problem for housing and upsetting what was seemingly working ahead of the conflict, where we had mortgage purchase applications started to perk up. You were going to see the manifestation in existing home sales starting to pick up as well. And Iran just not only did it take rates higher, but it took rate volatility higher. And our point on that has been, look, rate volatility has really dictated mortgage spread. So you had not only the treasury rate move up, but you had the mortgage rate relative to the treasury rate move up. And so you had a double whammy there for mortgage rates that really arrested that recovery that you were seemingly in as you turned the year over. The MOVE index now, again, if you want a baseline measure of rate vol, was sub 70 now with this stuff. And I think if this is for real, you could be back down to that 55 area that you were when you turned the year over. And that means mortgage spreads start to come in. They're about 50 basis points too wide. So along with your kind of 10-year yield coming down, which I agree with, I think you also have more compression in mortgage rates and mortgage spreads. And so rates, again, back below 6 is the call here if Iran is indeed solved. And that opens up a whole slew of activity in housing, existing home sales, which are about 1 million below where they should be just on a population adjusted basis. That's a full third. They start to move up, and all those consumer sectors that have been beaten down that are related to housing, that have been beaten down really for the last several years, also start working from a rate of change basis. And again, the sentiment there is still pretty bad. Anytime rates go up, it gets worse. So the setup looks pretty interesting there as well. So I agree with all those knock-ons.
Yeah, on the housing data, the worst of the purchase apps data we get weekly was actually back in February. February 20th was the low in the NBA purchase index. And it has been grinding back up over the last few months. We're sitting at we're not quite at new 3-year highs, but we're just below there. And so, yeah, any drop in rates, and I expect that rates are down this week, we should see continued upward momentum in that data when it's reported next week, perhaps. So, yeah, so we got, in your view here, the Fed's not going to hike. We could see mortgage rates once again with a 5 handle potentially. And again, in my world, our world, that means backdrop of really moving back towards Goldilocks. Multiples could even move higher on that disinflation, or pricing out the inflation anxiety. Lastly, I want to talk about employment for the consumer, because you guys have been arguing that the employment data is going to firm up, and you guys have been absolutely right. Over the last 7 months, we've seen the Bloomberg Labor Surprise Index move steadily higher. And so, with expectations now dramatically different from where they were 7 months ago, when consensus was calling for a negative payroll, I believe last month, which was beat, consensus was at about 85,000. We got a number of, what was the number, Jake? 160, 70,000 payroll?
Yeah. Yep.
So do you expect this trend to continue, or do you expect that at some point we'll see that data potentially level out at just a healthier number?
Yeah. So look, I don't think that's 100. We're doing close to 170 now on the payroll number for the last 3 months, right? That's been the average. And so I don't think that's sustainable, but you do have something here where we've tied the employment slowdown to tariffs. You know this, and we had a $300 billion squeeze in tariffs last year. It fed through essentially as a business tax because you weren't able to push price holistically on the consumer. You got no relief from exporters into the US on price. And so it showed up as really a margin pressure point for businesses. And they pulled that lever where they slow hiring. We've talked about this. And I think this is why you had the no hire, no fire backdrop for the last 12 months. And that started to shift when tariffs peaked. Tariffs peaked in October. And we put in the low in a lot of these employment numbers back in October. And so you look at goods producing jobs, the low in trend hiring and goods producing was October, and it's been up, and it's now it's in positive territory, right? So we went from something that was just bleeding jobs to something that's now adding. I think if the cadence of tariffs is not blown out here, you get to July, et cetera, and we're still lower than the second half of last year, I think that's all fine, and this will continue to work. This has helped the industrial recovery. We've talked about regional PMIs breaking out over the last 6 months. It's the same reason, right? And so you do have these events that are creating a broadening out in employment. And to the extent that you have some pent up hiring that you didn't do over the last year, you could clock in at something that's above 100,000, at least over the short term on a trend basis. Nothing suggests in kind of the real-time data, the most high-frequency data that we have, that we're moving away from that yet, right? So I look at weekly ADP, which again, short shelf life, I get it, but you have to pay attention to the trend. And it's still telling you over 100K on average per month here. You look at jobless claims, which even this modest squeeze up that you've seen recently, which is really more of a seasonality problem, which has been present for the last 3 years, they're exceptionally low. And yeah, I think we're on the other side of this no hire, and we're now seeing constructive hiring. And the thing about that is, when you look at consumer ammunition in general, the unemployment rate is going to come down if we add jobs to any significant degree here. So I'll give you an example. If we just did 100,000 over the course of the balance of this year, on average, right, you're at a 3.9% unemployment rate by the end of the year. And that's with no movement in the labor force. The labor force is structurally still coming down because of demographics. You do have prime age that's moving up. If you have a gradual decline in the labor force, say we go down to 61.6 from 61.8, then you're at 3.6 on the unemployment rate if you add 100,000. If you add 50,000, you're at 3.8. So we're sub 4 almost in any backdrop where we're actually adding job growth. And part of that is because the break even has come down so much because immigration's been throttled, and that's helping to put more downward pressure on the unemployment rate. But with a lower unemployment rate also comes typically better wage growth. It's not wage growth that has to be inflationary, as long as we keep a lid on unit labor costs. And unit labor costs, by the way, which is just wages inclusive of whatever your productivity is, unit labor costs printed sub 1% year over year in the last go around here. So they're very contained. You have a lot of headroom there where you can actually see some rising in labor costs without having a spillover into inflation. So yeah, we're constructive on job growth. Again, the tariff narrative kind of shifting, uncertainty vis-a-vis Iran, maybe coming off the boil as well as another add here for that story. And we believe that, again, if you're adding jobs, even between 50 and 100, call that your range, you're going to see unemployment rate fall below 4% in the back half of this year. And wage growth will start picking up. I'll give you one stat and then I'll stop my rant here. But we've done about 4.5% nominal wage growth this year so far versus last year. And that's come with very little job growth on a year-over-year basis. Again, we only started to add jobs in a significant way more recently. In 2019, we were doing wage growth of about 4.5 with about 1.5% job growth. And so part of that 4.5 was a very strong hiring market. If hiring starts accelerating, aggregate wages will accelerate to closer to 5% as well. And so that'll be another support for the consumer beyond the wealth effect of markets hitting the highs and beyond with what you, I think, rightly said, the inflation narrative, again, turning now to one that's more benign.
All right. So perhaps we should temper how low we think interest rates could go, because certainly if we see the unemployment rate decline, that could be something that limits how far, at least the long end of the curve will decline. But it sounds like, assuming that we continue to move towards the straight opening up, the impact from lower gasoline prices and all the other commodities that could be hit from that, and the fear of inflation coming off the boil certainly could lead to lower rates in the near term. On employment, I got to ask you about AI, because that always obviously comes up. It seems like the sentiment around AI job destruction has or is shifting. So what are you seeing there in the data, and what are clients, are you still getting a lot of pushback on that or not?
It's not really pushback. I would say the pushback that you get is, oh, it's coming, right? And okay, like I don't know how to retort that, because maybe it is coming. But so far, the evidence is just not there in terms of the impact. So we do a couple of things. We look at, there's this survey that the BEA does every week on how are you planning to implement AI? Have you implemented AI? And it's very broad, right? AI in quotes, machine learning, natural language processing, virtual agents, voice recognition, all these things fall under that bucket. And what is, there's no correlation between AI plans or AI usage and job growth by industry. So industry X is saying our plans are this, our usage is this, and there's just no correlation between that and whatever their job growth has been over the course of the last year. We have some very specific examples within industries. You look at the software development space, we've talked about this a lot, but job openings in that space have just rocketed higher since January. They're up maybe 20%, 15 to 20% just since January. They bottomed this time last year. Our point on the tech rec and jobs specifically has been that, look, that was a function of the Fed tightening very aggressively, circa 22 and into 23. And as they eased over the course of the last 18 months, that pressure unwound, and you restarted that hiring cycle in tech, which fits with the bottoming out process in something like the software development space. But that was supposed to be a sector, and we pick on that one because that was supposed to be a space where you were supposed to see massive disruption. And why are you going to be a software developer if AI is just going to vibe code everything, right? We've seen the opposite. We've seen a tightening of the labor market there. So not only job openings moving up, but wages, and this was through April, it's lagged by a month to the overall report. Wages, average weekly earnings of software publisher employment was up about 9.25% to 9.5% year over year, which is almost 3x what the average going wage rate is. So it's a very tight labor market in that space. And then the last one that I'll point to is AI was deemed to be destroying entry-level jobs. And this was a huge theme in the back half of last year. And you did have the 20 to 24-year-old unemployment rate move up to about 9% in the second half. That was the high. Again, I thought that was more about tariffs. Entry level is the low-hanging fruit. If you're throttling employment down, they're going to suffer more. And as tariffs peaked, the unemployment rate for 20 to 24-year-olds came crashing down. I had a 6 handle on it. It's around 6.5 to 7 now. And the spread to the overall was at a near 60-year low as of March, April, May. And so the whole AI killing entry-level jobs thesis just evaporated here. So we're still very constructive on AI. We think if you create mechanisms that help you deliver goods and services cheaper, and those goods and services are in demand, people are going to demand more of those. We've seen examples of this throughout history, and I don't think this time is going to be any different on that front. And ultimately, it will be just another tool that employees can deploy and just become more productive with. And so this is part of a theme that already existed before COVID, where capital investment in productivity enhancing mechanisms exploded post GFC and grew at a faster rate than the IT revolution. We were getting dividends from that vis-a-vis productivity already in the back half of the prior cycle. And we're seeing it today. Productivity is running about 2.5% average annualized over the last 2 years. And we expect that to continue, if not squeeze higher. So your point, just wrapping this AI thing now back to your point on rates. Yeah, I agree with that. And I think rates should be higher because growth is getting marked up. If you look at which I think this is one of the most important charts on rates, is if you look at the relationship between the 10-year and nominal GDP in the US, nominal GDP on a trend basis was around 3 post GFC, secular stagnation, et cetera, et cetera. We've completely re-rated growth. We're now averaging about 5.5% over the last 10 years, inclusive of all the volatility around COVID. And we did 6%, just over 6% in Q1. We're probably going to do at least that in the second quarter, year over year. And that's totally a 5%, 5.5% nominal GDP trend is totally consistent with a 4.25% to 4.5% 10-year. So yeah, with inflation tame at 2 and kind of real growth in and around 3, when you have productivity at 2.5 and a labor force growing at about 50 basis points, no one should have an issue with a 4.25% to 4.5% 10-year. As long as growth is keeping up with it and outpacing it, that is not a problem.
Thank you so much, Jake. This was very informative. We don't do house views here at Piper Sandler like other banks. So to hear you and the economics team being so positive while we are positive on the economic outlook is great.
Always a pleasure, guys.
If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.